Okay, folks, we'll kind of get started here. I'll just do a little bit longer of an intro. We do have a lot of folks coming here. I know it's the top of the hour, and let me just give you a little background of kind of where this came from, the webinar in general, this topic. If you've been in the long-term care industry, and first of all, let me just tell you, my name is Jeff Clark. I'm a regional director here at GoldenCare. I've been with GoldenCare for 24 years now. I spent my first 4 or 5, probably even 6 years in the field just selling long-term care exclusively. I cut my teeth on long-term care. I guess I never really knew anything else. I didn't sell anything else. Eventually, of course, we all started doing annuities and med subs and life, etc. So, you know, I've basically been in long-term care for 100% of my career. Years ago, I got promoted to this director position where I recruit, train, compare, and contrast long-term care plans, help brokers all over the country with, comparing just different long-term care plans and 10-pays, home care only. Well, if you've been in this industry long enough, you know that the hybrids are a very, very big moving factor in this industry we're in now. Matter of fact, 10 years ago, there was 5 long-term care plans written for every 1 hybrid out there. And I say hybrid, by the way, we're talking life and long-term care, hybrid plans. So it was 5 pure traditional long-term care for every 1 hybrid written. Well, in this day and age, we're closer to 4 to 5 hybrids written for every 1 long-term care. And so it's definitely changed our industry. I don't think anyone disputes that there's still a need for long-term care out there. People are still looking for a solution. And when the rate increases got bad, when the industry kind of didn't know what they were doing for a while back, 20 years ago, companies were getting out of the market. It kind of created this opportunity for people to start selling these hybrids. So, in a nutshell, we saw a real resurgence to them. And I, again, as a person who's trying to help my agents, with comparing, contrasting, being competitive, and so on a given day, I'll have someone call me and say, "Here's what I'm up against. I'm up against, a Genworth plan, a Hancock plan back in the day. Now I'm up against." I've got a Pacific-like plan that their financial advisor is advising them to buy, or a One America plan, or Lincoln Money Yard. So with that, over the last 2 years or more, I've been kind of comparing, contrasting, trying to go into these things, and really I've noticed a lot of, I guess it raised a lot of questions for me as to why are they so popular? Why are so many people selling hybrids? When I look at it and I break the products up and kind of do a little different thing, you come out so much better ahead. So that's kind of the gist. It's long enough intro. I'm being told that everyone's kind of on board here. So, but first of all, before I start doing some of these comparisons, I just want to talk about the fact that, when I'm designing long-term care plans too, I'm trying to get the most bang out of my buck when I'm designing traditional long-term care. Now, there's a variety of folks on this webinar, some that have a lot of experience. I recognize some names that are heavy hitters, if you will, and I have some people that maybe write 1 or 2 a year. So, just real quickly, the short and fat model of designing a plan is kind of the way to go. In other words, I have a policy maximum here of $270,000. A long skinny plan would be $150 per day or $4,500 per month for a 5-year benefit. 5% compound. Annual premium in that, and I'll go ahead and take a look at that. So the annual premium there, I'll make this a little bigger so you guys can see this software here. I guess it doesn't matter. Okay, $92.16. And so what I like to do then on this is I'm going to do a shorter, fatter design. I'm going to keep that pot of money at $270,000, but we all know that 90% of long-term care claims don't exceed 2 years, and so you really want to shorten fat. You want to make that benefit as much you can pay up in front as possible, because that's how the client gets more bang for their buck. So I'm going to go ahead and move this all the way up to $7,500. Okay. Notice that moves it to 3 years. Again, big deal. We're still talking about a $270,000 pot of money. I'm going to move my inflation down to 3% because I'm still getting that same $2.50 per month growth. Of course, at some point it passes it over. And I'll take my assisted living down to 50%. A little less than it was, but pretty close. So by doing these things, I have taken really nothing away. In my opinion, I have bolstered this person's long-term care plan considerably, because if you go down to a local nursing home and you only have a $4,500 a month benefit, you're not going to get the whole thing paid. And so a shorter, fatter design, and I'll just go ahead and minimize this out, that shorter, fatter design is going to be a lot stronger than the long, skinny. So people say, well, of course, the 5% is going to catch the short fat. Now, this was for a 60-year-old couple. So average claim happens about, 82, 81. So, 10 years from now, this policy's paying The long's getting 7,000 versus 10,000. 20 years, it's 11,009 versus 13,000. So the crossover point's somewhere in the 27th, 28th year. So basically, this person has a better plan for the next 30 years, and for about half the premium. So anyways, as I move forward, just keep in mind that I'm designing these things in a short, I'm trying to make the long-term care part of it the most efficient as I can. So anyways, I go into comparing things, and this is, I'm just going to start, and many of you have been on this thing before. This is the first that started it all. We were kind of tied to the hip with Securian for a while. We put together a couple plans with them. The Care Shield, of course, which is on here, which is now gone, and the Eclipse Protector. It's been restructured, and actually the rates have went up about 15 to 20% on that now. So rather than changing all this, just to get the concept through to folks, I wanted to keep this here. So when I started comparing long-term care plans, I realized that, if you separate these plans out, if you just sell a separate standalone second-to-die life policy and add that with the long-term care premium, look how it works out. Now in this example, to keep things simple, I'm just doing a $125,000 death benefit, which equates, of course, to a $5,000 monthly benefit. Most of these hybrids use a 4%. So in this example, it's $125,000 and a $5,000 monthly benefit. Okay, and this is for a 55 and 50-year-old couple. No inflation. Let me just, for the matter of fact, bring my software up so I can show you what we're doing here. We'll try to keep you. So I'm going to do a 55 and a 50-year-old. And again, we're just going to do a $125,000 benefit here, $5,000 monthly, and we're not going to have any inflation. Okay, we'll keep everything else kind of there. I know this is not partnership. So see the premium there, $1,330. Right? So over here, then of course, I've got $1,330 on there. Then what I did is I went ahead and got a second-to-die life. This particular quote came from AIG. It's a guaranteed UL, second-to-die, $1,166. So if you add those two up, it's $2,400. Okay? Well, since I had so much extra premium to play with here, I went ahead and put the 3% compound on this quote. So I went in here, went ahead and put the lifetime 3% on there. So now I got partnership. So now the premium's $2,866. So over here, $2,866. I still added the same $125,000, guaranteed, second-to-die death benefit. Now my total is $4,032. Again, these two plans have been changed. They're actually more expensive, and Care Shield's gone. But just to get the point across. So what does it look like come claim time? So again, if you look at just the pure example here of no inflation, for $5,000 a year, I get a monthly benefit if I need long-term care of $5,000 a month, until $125,000, or I get a death benefit. Right? It's either or. I can use that $125,000 for long-term care benefits, or if I don't use any of it, I get $125,000 death, or any portion I don't use in long-term care, I get the remainder in death. But you're not getting any more than $125,000. It's either or. So I take a look at down here. For half of that premium, and this is kind of what got the ball rolling for me. For half of that premium, I can get a guaranteed death benefit of $125,000 no matter what happens. I don't care if I go to a nursing home or have a stroke or die in my sleep. Because I also get a long-term care benefit of $125,000 so I'm getting both benefits for half the premium. And again, this has just got me thinking, is this true of all hybrids and all? Yes, it is. You're almost always, I can't find a situation where there's not yet, but I'm going to say almost to cover myself. You're almost always better to break these products up. By putting them together, not very good deal for the client. Okay, great deal for the insurance companies, but for the client and for the agent, not so good. So let's just say we went ahead and put that 3% inflation in there. Remember, that'd be my premium $4,000. I'm still coming in considerably under the hybrids. But look at come claim time. For less premium, I have a monthly benefit of $12,000 versus $5,000. I have a total LTC benefit of $303,000, not just $125,000. And if I use all of that, doesn't matter, I still have a guaranteed death benefit of $125,000. So I would look at these two plans, and I'd have to look long and hard before I would sell something like this. Breaking them up, whether you want to spend half the premium to get twice the benefit, or if you want to send similar premium to get 3 times the benefit, however you want to say it. So okay, let's take a look at some more examples. I hope this kind of slide gives you the premise of this. So let's move these folks up a little bit. Same example, just to kind of tell you it works at different age spectrums, different. So here I'm going to go ahead and show you the next. So I went ahead and moved this couple to 65 and age 60. Okay, so if I go into software here, I'm just going to change their ages. Let's put them up to 65 and age 60. Okay. Premium now $39.37 with inflation. Without inflation, if we take that out, $22.02. Okay, so let's go ahead and do this. I'll go back into presentation mode. I know it shows better. Okay, so if I'm looking at the long-term care premium in this, again, these are no inflations. The premium for the long-term care premium, $22.02. Now, of course, these folks are older, so a second to die now, and this is, again, this was the AIG I used. You can use any life company. I'm sure you guys have life contracts somewhere. If you're not, GoldenCare is happy to help you with those as well. $18.65 a year for the second to die life. 22, that's a total of $4,067. Again, a little bit less than these two, and these are, again, these are now higher. This one's gone. This one's higher yet. Then I went ahead, again, I had extra premium to play with here, so I went ahead and put that 3% inflation on there. Of course, you guys saw the premium was $39.37. So my total now is $58.02. So what does this translate come claim time? So again, here's a premium that's half of what the other ones are, less than half, and I get both benefits, not an either-or deal. And again, hybrids are getting, it's great because, why are we doing hybrids? Well, what if I die in my sleep? I never use these premiums. And so playing on that fear, we went ahead and we did this guarantee where they're going to get one or the other no matter what they pay. Well, and they're paying through the teeth for this, by the way. So it's kind of the way the industry has shifted to say, let's take advantage of our clients' fears and really stick it to them in premium, right? It's hard for me to fathom why you would pick something, again, that's an either or versus both guaranteed. So, and if I put that inflation in there again, I add that little extra premium in there, so now I'm at 58. I'm still coming in well under these plans. And look at it come claim time. Oops. Let's go back one. So $9,000 a month versus just $5,000 a month. A pot of money of $225 versus just $125,000. And oh, by the way, even if I use all of that, I still get my guaranteed death benefit of $125,000, all for quite a bit less premium. Okay, so I have done this particular example. I have shown these for a while. I've done this thing for, I don't know, a year and a half. And so people want to know, what about the other hybrids, other age brackets, singles, 10-page, there's all these factors. So what I did is I put together another 4 or 5 examples here, and I'm going to kind of buzz through them. And, of course, I'm going to open this up to questions at the end, and I'm really hoping that it does open some eyes. Now, when we first did this, we didn't have a pair of gloves on here. We weren't talking about the gloves are coming off. And the more and more that I do this, I guess I'm just feeling more confident to say I am very confused as to why so many hybrids are being sold. We're not anti-hybrids. There are situations out there, folks, where, someone's got a lot of money sitting around in an old life or annuity. It's got to be moved. Maybe they're on required minimum distribution. There's looking for a certain, but the hybrids are a very necessary part of our industry now. My personal opinion here is that they're being overused 9 out of 10 times. Okay, there's just not a situation where you have to buy the hybrid. There are some where it makes a lot of sense. So when you see these gloves on here, we're not trying to necessarily compete, as this kind of just points some things out to you. Okay, so I'm not trying to upset any of the hybrid people who are hybrid-only people, and I do know them. There's a lot of agents out there that are completely left long-term care now, and they're only doing hybrids. So if any of those are on board, just bear with me here. Okay. So here we did, this is Nationwide. All right, they have a hybrid as well. And by the way, when I go through these hybrids, I put a little asterisk down here. Nationwide does, they do have a lifetime pay, an annual pay. Theirs is paid up at $8,100, which most of these second dies, similar to the second dies. So just going forward, I did this on this particular plan with Nationwide. It sets up to where when you want a $5,000 a month benefit, reverts to, I believe it's, I want to say it's 40 months, or it ends up being $185,000 long-term care benefit, which translates to a $5,000 monthly benefit. That's with 3% compound inflation now. And that particular setup with Nationwide will pay you a guaranteed death benefit $120K. All right, this is Nationwide's Care Matters 2. That combined premium for a 55 and 50-year-old annual premium, $9,356. Now, if I want to buy that same benefit for long-term care, $185K and a $5,000 a month benefit with 3% compound, let's check my math. I went through these a couple times, but just to make sure. So I'm doing 185 and 5K with 3% compound for a 55 and 50. So let's do 55 and 50. We're going to put that 3% in there. We're going to do 185K. There's a partnership plan. And there you have a premium now at $35,63.80. I don't have to get so $3,560. I won't keep going to software. I'm just trying to keep myself honest as I'm doing this. Okay. So if I'm breaking the plans up, here again, this is 120K second to die death with Prudential. This was 1,016. I found a little better rate than the AIG one I was using before. But again, the life product or company or plan you're using doesn't make any difference really. I mean, we're obliterating the hybrid, so it doesn't really matter what you use for a life company. But okay, so if I add these two together, I'm looking at $45.79 to accomplish this versus $9,000. But remember, what's different about combining the two versus just breaking them up? Well, here again, I'm going to emphasize the heck out of this. Or. So yes, they're both growing at 3%. So average claim happens at 82, 85, so 30 years down the road. For my premium of $9,000, I've obtained a benefit of long-term care of $12,000 a month, and I've got a pot of money of $449,000. If I happen to use all that up, I don't get my death benefit. It's kind of an either-or deal there, right? But down here, for half the premium, right? Literally half the premium, I have the same exact benefit for long-term care, but I have a guaranteed death benefit on top of it. Again, hard for me to understand why anyone would buy that, this Nationwide Care Matters versus the long-term care coupled with a second to die life. Again, my point here is breaking these plans up, a lot better for the agent and for the client. Okay, so moving on, did the same thing for, I believe, so we use Nationwide again. I moved it up to a 65, 60-year-old. That bumps the premium up to $15,000 annually for the Nationwide thing. Same $185K, $5,000 a month benefit, $120,000 death benefit is what it equates to. Now the premium again, it's getting worse, isn't it? Now it's less than half, $64.40. Now my life premium's up to $16.20. My long-term care benefits up to long-term care is $48.20. So now I have that combined total of $64.40 versus $15,000. Again, now it's less than half of the premium. And the benefits, again, they're going to be the same for long-term care, same for death, except for I get both, guaranteed. No questions asked. So for 40% of the premium, I'm getting both benefits, same long-term care benefit. Okay? All right. So let's go to, what do I got next here? One America. It's very popular. It's the #1 out there. And again, we're not trying to disparage any hybrid company here. These are all companies that we work with. And, there are times and places for writing One America. Plain and simple. There just are. I'm not ever going to argue that. But let's just look at a long-term care coupled with a life premium compares to this one. All right. So, as you know, if you do much in this industry, the One America is a little different animal. It's got the beginning thing of benefits, and you got the continuation of benefits. So I'm going to try to show you one of each here. So with the AOB only, with One America, this is without the continuation of benefits. I'm going to do 100, and this again, they all set up a little different when you run the quotes for them, and I'm trying to match things just as closely as I can. So in this particular example, I got a 55 and 50-year-old female, standard health. I'm going to do a death benefit of $166,000. And on the long-term care, I'm going to do 3% compounding, 33 months is what it works out to. The One America, you can do 33 or 50 months. $166,000 benefit at $5K a month. So that's the long-term care benefit we're talking about here. They're both going to be inflating at 3%. So again, if I'm going to go ahead and that combined total with One America, with a 55 and 50-year-old, 75-15. Okay, now both of these are inflating at 3%. So then I'm going to go ahead and I'm going to do a long-term care premium with the same benefit, $166,000 and a $5,000 monthly maximum benefit for a 55 and 50. Check my math real quick again. Let's just do it for this first example, One America. So I'm going to move this to 166. And that premium should be, again, $33.46. Hope you guys can see that on your screen there. So over here again, $33.46. Okay. And then, of course, a second to die here at $166,000 with Prudential is $12.45 for the 55 and 50-year-old. So those the total there was $45.91. Where One America, again, $75.15 for the same thing. But remember, there's that caveat. You get both. All right. So now we're going to add that continuation of benefits. That's the one area in One America that I can't find anything to really fight with there. If you know traditional long-term care, they max out at a $500,000 pot of money with a shared care benefit. 3% compound, so you can grow those benefits up to $1.5 million, but they just don't cut you loose with unlimited anymore. Okay. The industry got in a little trouble with that. The actuaries had and it wasn't just, Genworth or Hancock that wrote too many unlimiteds, and look what happened. They had to get out, right? So that the unlimited model is really, really hard on the company. I'm hoping that One America is going to be okay with their unlimited things they're offering, and that there's not going to have any adjustments like the rest of the industry. And so it seems to be working out for One America. But you just don't see that in the industry anymore. So the most I can do, of course, is the $500,000 benefit. So to compare the one that has a continuation of benefits, in other words, that's the answer to unlimited benefits, right? That premium is $13,890 annually for this 55 and 50-year-old. So again, just to be fair, all I can do is a $500,000 pot of money at a $5,000 a month benefit, and I could put shared care in there. Let me show you this real quick. So again, that's as high as I can get, right, using traditional long-term care. So the same thing, I'm going to jack this all the way up. So a $500,000 pot of money. I'm going to put shared care in there. And look at my premium now, $69.50, 22. So $69.50 is what it's going to be, all right? So if I add that with that, again, that second to die with a $166,000 death benefit, $12.45. Add the two together, $81.95, $13,890. So how does it compare when we look at them side by side? So right away, we're severely under on the premium. So the one that compares straight up, because this is the exact same benefit to the exact same benefit, right? There's not a continuation of benefits on here. So what you have here is a premium of $75.15 annually for this couple with One America for a $12,000 a month benefit, and a total of long-term care benefit of $166,000. Excuse me, death benefit $160,000. The long-term care benefit's $402. I think these are transposed. I apologize. So you've got a guaranteed long-term care benefit of $402 at $12,000 a month. Same thing you've got here. You got a $12,000 a month benefit with a $402,000 LTC benefit. But the difference here is you have a guaranteed $166,000 burial. In case you happen to burn up this long-term care benefit, that's $166 is now gone. So you can use up all this $402. You're still guaranteed that death benefit. So again, less premium, both benefits instead of just one or the other. Now, continuation of benefits. This is, again, where to be fair. So at $5,000 a month, One America is going to offer you an unlimited benefit for long-term care. The death benefit, of course, is going to be $166,000. Okay. Then you have your long-term care benefit here, $12,000 a month. And the long-term care benefit, now this is a shared benefit at $1.213 million. Now, I know that's not unlimited, but that's a shared benefit. So between the couple here, we have $2.4 million to be shared between the folks. Now, that's not unlimited, and I'll give you that argument. But when we're talking about a premium that's $8,000 versus almost $14,000, you know, I can maybe tell people I can give you a $2.4 million benefit for long-term care, still give you the same $5,000 a month, and actually, you know, those have grown. That would have grown to 12. This should not be 5 here. This should be 12. I apologize. Yeah, they're all $12,000 a month. So again, instead of having this just a unlimited benefit, I can offer them a $2.4 million, $1.213 million each. So again, even if I'm going against the One America and you know, AB only or the AOB and the continuation of benefits, you're still coming out way ahead to offer both. Again, I apologize for the slide. This 5,000 here should say 12,139 as well, so apologize for that. Okay, so here we're going to do a married couple, same thing. We're just going to move it out to 65 and 60. So here the combined annual premium is now 10,243. Long-term care is 4544 for the long-term care portion of this. Another 2,063. Of course, they're older for the second to die life. So totals are 6,607 versus 10. If you do the continuation of benefits, again, I'm going to do the 500,000 shared care benefit. Load this thing up as much as I can. 11,709 is a long-term care and life combo premium versus 19,153. Considerably less premium. And so what are you giving up? Not much. Obviously up here the benefits are going to be the same, right, because there's no continuation of benefits, so we have a 33-month benefit here. So 30 years from now, when these folks go on claim, 20 years from now, $9,000 a month benefit and a $299,000 age 12 long-term care benefit, or that death benefit of $166. Whereas again, with a long-term care, traditional long-term care, and a second to die life, you got a $9,000 a month benefit, and you've got a $299,000 same long-term care benefit, but you got a guaranteed death benefit. So it's an and, not an or. All right, for a lot less premium, you get both benefits versus one or the other. It's kind of going to be a theme here, I guess. So even if we do the continuation of benefits, and here again, to be fair, they get $1.2 million each shared. So it's $2.4 million between the two of them at the tune of $9,000 a month, and they get a guaranteed death benefit if they haven't used it. So here you're getting both for a premium of $11,000 versus $19,000. Similar benefits here, just considerably less premium. Okay, so a lot of the other hybrids out there, they're going to have a 10-pay model, and that's the tough thing to comparing all of them. You know, now the Eclipse Protector that I opened this presentation with is now a 10-pay, so you can't, you know, it's. So I went out and found NGL. They have a 10-pay, right, in the long-term care arena. And so, of course, getting to match up is tough. NGL, I had to use a 170 a day, which translates to 5,100. They only had a 5 years, so it translates to 310,000. The Pacific Life, to make it as close as I could, I did 10-pay here. They have a $330K benefit with a $5K a month benefit for long-term care, which translates to $120,000 death benefit. I didn't do two examples here. I just did one. So the Pacific Life premium on this is a 10-pay now, mind you. $44,088. That's to have $120K death, or to have that, you know, $330,000, $5,000 a month growing at 3% compound. So I ran that benefit, and again, with NGL to get it to match up, I had to run $310,000 and $5,100, as close as I could get there. That premium, $14,380, 1/3 of the price. Okay, so again, that long-term care premium, $12,760. Second to die life at $120,000 amount was $1,620 annually. $14,000 versus $44,000. Let's take a look at the benefits. Okay, they're going to be slightly different here because, again, we're starting at $310 and $5,100. So come claim time, 20 years from now, for my $44,000, I get $9,000 a month benefit, and I get a total long-term care benefit of $596. Versus for $14,000, one heck of a lot less in premium, I get the same, well, a little higher, $92.11 per month benefit, a little lower in the overall, $559. Oh, and by the way, if I use this, remember, I still have a guaranteed death benefit, both. So for 1/3 the premium, I get both benefits. Again, it just gets hard to wonder why people are selling hybrids. Okay. I'm kind of closing up with this. So I've kind of showed you that I'll say this. It doesn't matter. I've got more comparisons in this stack of papers that I've been working on than you can imagine. I've done this against single people, single females, single males, married, non-married, all the companies out there, the Lincoln Money Guard. It doesn't really matter who you're comparing with, who you're going up against. You're almost always better to break these policies up versus combining them into a hybrid. Okay. Now I know that again, there's some people that have $400,000 sitting around that something has to be done with. Maybe you plunk that into a hybrid. Most of the clients I ran into in my 23 years, or I've written 700 policies, I guess, I don't run into a lot of people that are just going to cut me a check for $400,000. I know it does happen out there, and that's why these policies exist. There are times that they fit. One thing I want to say before I talk about the biggest objection to all this is we have a mechanism, even with Mutual Omaha, by the way, and this is overlooked. There's this 3 times the monthly benefit return of premium rider, if you will, or I call it the final expense, that's built into long-term care. If you don't know about this and you're having customers that are bucking you about getting their premiums back, what if I die in my sleep, I don't get anything back? Let me just show you something quick. So since you get 3 times, and I'll just show the software here. So in this particular situation here, we went to a $5,000 a month benefit. Shorter, fatter, usually better, but typical policy I'm going to write, might be $6,000 a month benefit, and I might do like, I don't know, $200,000 pot of money. But, some people argue that I'm just going to take the inflation out. I'm just going to go ahead and, double it. I'm going to go to $10,000 a month and just do a $400,000 pot of money right away. Same money and premium, right? I'm just going to front end load this thing and load it, extremely short and fat and take that inflation out, right? So now, the premium's about the same thing, but I went ahead and just doubled that monthly. Now, if you sell with this strategy, and I'm not saying anything wrong with it, I'm not a big fan of partnership, it never really happens anyways. So if you're selling with this strategy, just scratching the inflation for older folks, etc., then built into this plan, you have this ability to get 3 times the monthly benefit. Look at the cost of this. So this is $4,000. Look how much it puts on per load. So if I want to get, as this works out, you get 3 times your monthly benefit in the form of a death benefit. Call it a burial fund. So I get $30,000 each by putting that on there. I can't have shared care. No. Okay. So without shared care, and I put this on here, the 3 times. So without it, okay. So without the shared care in this deal, $10,000, $400,000. Premium at $34.48. So if I put that on there, it's a tiny load. We're talking about a couple $100 a year for a 55 and 50-year-old to get a $30,000 burial. Now you're not going to find that in the market, folks. You're anywhere. It's just it's a throwaway. So if you're not using it, you probably should take a look at it. But here's what I think: it helps alleviate. So if this person's paying $3,700 a year, they're 55 and 50. What if you paid those premiums for 30 years before claim time? Well, that's going to be like $100,000, right? Well, if I'm going to give them $60,000 of that back, then they're getting 60% of their premium back. That can help those people that are saying, well, what if I die in my sleep? Well, let's give them 60% of their premiums back, and let's not charge them $11,000 to write a hybrid, right? Of course, you can go buy a second to die like I just showed you, but if you have people that are in between, kind of on the fence, don't forget about this little 3 times monthly benefit. It's a heck of a deal, and it can capture, I don't know, 50, 60, 70% of people's premiums back with a very tiny little load. Look at that load. It costs almost nothing to do that. In other words, would you like 60% of your premiums back guaranteed? It's a couple $100. Who's not going to do that? Especially if they even give you that hint of, what if I die in my sleep and I can't? Okay, I think I made my point there. So I'm going to close with this. One of your bigger objections you're going to find when you do this, and I do get beat up on this, and again, I know that there's some hybrid writers out there right now that are probably not very happy with this, or they're a little upset, and they're not factoring rate increases. Okay? So, yes, the long-term care industry had some rate increases in the past, didn't they? They had some trouble. You had actuaries quoting things. They didn't get the persistency right. They didn't get the utilization right. They had no claims data to go on. So what happened? If we look at it, if you look into today's policies, there's much more price stable than any prior product generation. The Society of Actuaries pricing study shows the underlying actual price assumptions have been de-risked now. We've got enough Lapse rates now set at lower than 1%. Investment returns now, they're using ultra-conservative interest rate environment here. They're not trying to use expected return of some high number. They're doing the lowest ever, right? The claim rates, they're more conservative rates they've ever used, okay, allowing big, increased data, 16 times more policy data and 70 times more claims data to go on than even 15 years ago. Regulatory requirements, consumer value, company penalties, margins for error, actuarial certifications. Fact of the matter, take a look at this. You know, how many data did we have to go on in 2000? No, not much, less than 1 million. 2000 jumps to 2014, we're at 7 million policies to date. Policy duration, we have a lot more research to look at here. Okay, now attained age 80 and policy duration 10 years or more. Now we've got, you know, all kinds of data to go on. But look at this, rate increase filings by year. You know, we talked about the problems we had back, the policies that were written in the 90s. You know, when I got started in, I guess it was what, 96, 97, I started writing policies. Yeah, if you've been in this industry for 20, we lived through this ugly period of rate increases. But if you look at policies that are written today, they're not going up anymore. They're using safe assumptions. They have actuarial data to go on. Matter of fact, the Society of Actuaries puts together chances of rate increases. In 2000, they were saying these things are 40% likelihood to go up. 2007, 30. 2014, a colleague just told me the stat in 2018 is 5% chance of going up maybe 10% in premium. In other words, it's likely not going to happen. Can't say guarantee, but let's just say that they do go up. And by the way, we're referencing this from the article. If you don't have this, ask us about it. It's an article about long-term care insurance too legit to quit from Broker World magazine of March 2017, where all these stats came from. In a nutshell, if you read that article, you're going to feel a lot better about the rate increase potential of long-term care. But let's just say that these things do go up 10% or 20. Remember, when we're doing these things I just showed you, and I can back up and just show you any one of them, right? We're killing them in premium, killing them. So if you want to go ahead and just double that death benefit on some of these, you know, maybe just bump the 120 up to, I don't know, 180,000, well, you're covering any rate increase that's happening, and you're still well below in premium. So if you want to argue the rate increase thing, I get it. I do. That it's been ugly. But in today's rates, today's environment, the chances these things are going up are very low. And even if you did, if you still want to go there, then just put a little bit more money in that life policy that you're writing, and you're going to cover that. Cover 100% rate increase if you really think it's going to be that way still. You're still going to come in considerably under. Okay. I've hit you with a lot. Thank you for getting through that. I'm going to try to go ahead and open up some questions. Let's take a look at that. 800-842-7799 is our number for those of you that may want to give us a call. Otherwise, visit our website at goldencareagent.com. All kinds of tools, resources, pre-recorded trainings from a variety of personalities besides myself. We've got Tom and John Randall on there. Jen's got some recordings on there. I think even Mark Randall's still on there. So all kinds of tools, everything you're seeing in bullet points here. So please visit our website. Give us a call at the marketing office. If you're working against a hybrid plan as we speak, I mentioned before, there are numerous life products plans out there. You can use pretty much anything, first to die, second to die, a GUL, guaranteed life. We can, if you don't have those contracts, we'll help you get some. The premise of this thing is, again, breaking those plans up. Selling an individual a separate life and a separate long-term care is a lot better than combining them. So with that, let me see if I have any questions here. There's probably a couple, and I'll go ahead and let everyone go. Okay. All right, so these are all really, I'm going to try to answer a couple of these folks and to see if I'm just going to read through a couple of these here to see if they're going to, oh yes, somebody dipped out early because they're mad about the rate increases. I thought, too bad I didn't put that in earlier. Lots of comments about the fact that there's no guarantee on long-term care rate increases. Yeah. Sorry that person happened to leave. I think that, yep. There will be recording. Another question here, there'll be recording. Will we hand out the slides? Yes. I got to fix one part of a couple slides here, but we'll get that out to you. And yes, another one, can we see the PowerPoint? Yes. Why would a prospect not do this? Okay, thank you for that comment. Would hybrids for, the underwriting for hybrids be less severe and easier than traditional? No. Hybrids are underwritten every bit as tough as the long-term care. A lot of people feel that way. They get declines from a traditional long-term care, then they go try to do a hybrid. You know, they're kind of similar risks there. I mean, the life and long-term care company would rather play out a death benefit than a long-term care benefit because they're usually a lot higher than the death benefit, so they're going to still underwrite you. And then another question here, how do premiums hold up when the clients are in their 70s? Yeah, because I did the 55, so I ran a 55, 50, 65, 70. I can tell you the older folks get, the more ugly it gets for the hybrids. Like if you're selling a 70-year-old hybrid, you're really kicking them in the shorts. You're not doing them any favors, let's put it that way. Another question, yes, recording is valuable. So then there's another question here. This is a good one here. He said, can you calculate a formula, can you use more death benefit to cover possibly even 100% future rate increase? That came in, again, probably just behind what I just mentioned there. But yes, if the people are worried about rate increases, then I've always said, look, you've got twice the premium to play with. Bump up that life benefit, 50K or 100K. It's not going to do that much to your premium. It's going to add 500 annually to any of these examples I gave you. So now you've got all kinds of room. So if you want to argue the rate increase thing, you can cover it either by what I just told you about the Society of Actuaries and the too legit to quit. But if you don't buy it, like some people are skeptical, and I get it, well, then you just go ahead and put some more money in that life policy, and you're taken care of. They're going to get all their money back. Okay. And then I got another question, if it looks similar to 50 or 60-year-old individuals. Yes, I did single females. Naturally, the single females actually show up a little less competitive than the males because for some reason the hybrid industry hasn't figured out that 80% of claims are women yet. So if you look at the rates for hybrids, interestingly, hybrids are less money for females than they are for males. And they're still thinking their life policies are using life tables, even though the benefit, the potential for risk for these companies is a lot more on that long-term care end, especially for the women. I'm wondering when they're going to start adjusting that. But yes, I ran single females, single males. My next version of this, I'm going to put in just some pure singles, and we'll do a GUL against them just to show that, yeah, there's not a scenario that I have found that it's not severely better. How about states like Florida for single females? Same thing. Yes, they're still going to be cheaper. And then another comment, thanks for this, that, you know, more people would do this, but the problem is that no one's presenting it like this, and I think that's true. That's the whole premise behind this. And there's another person asking me about what plans we have for secondary die. We do have a couple options there. So, folks, that's kind of all we have here. You know, and for folks who are big believers, you know, I know I got a bunch of you still on here. I want to say one thing quick. You know, I had a guy who was an absolute, let me escape now. He was an absolute believer in hybrids. And he brought this quote to me, and you guys might recognize this quote if you've been doing any hybrids. But this is for a 64 and 62-year-old. Okay? And they wanted to have a $300,000 face death benefit. They wanted to have that unlimited benefit. And so the premium for those folks, $18,231. Pretty steep, right? Okay, so I went ahead then and I ran a long-term care benefit of $500,000 with shared care. So now, of course, that extrapolates out to $1.24 million each, and so you double it, it's $2.4 million shared benefit, unlimited, growing at 3%. So the premium for that came out at $1,179. I added that at that age bracket, 64 and 62, to have a $300,000 death benefit. That premium was $39.80, so the total was $14.9, as opposed to my longtime hybrid writer's $18,000. What ended up happening is he actually ended up bringing this premium down. He said, they don't have to have a $500,000. He ended up doing, from memory here, it was a $500,000 for 64 and 62. Again, this is a person who's done nothing but hybrids for a long time. And after sitting with him and talking about this, he ended up lowering his benefit down to $300,000 instead of the $500,000. Still kept it at that $6,000 level, the inflation in there. And the premium, granted, it was $75.39. And so he goes, after that little bit of give up there, $300,000 versus, and I had the shared care there too. Excuse me. Yep. It was $8,000. Well, this guy, again, he's driven nothing but hybrids. And I'm not sure who he used for life, but if you add the $8,000 to, say, again, a $3,000 or $4,000 life, so that totals $12,000. The following Monday, after I talked to him Wednesday and Thursday of that week, the following Monday, lo and behold, he submitted a $7,900 or $8,100 long-term care case. So I know the people that are exclusive hybrid writers can be turned if they just look at it. So anyway, I hope that happens for anyone that's on this thing. I'm going to go ahead and wrap this up. For those of you, again, that have a case right now, my PowerPoint. If you have a case right now you're working on, give us a call. I'm going to put this number on the screen for a little bit and wrap it up. Thank you guys for coming on board today. Guys, gals, big class today. I hope this was an eye-opener. Our number, of course, is 800-842-7799 if you need us. Jeff Clark signing out.